Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing WSP Global stock. This one came in by request down in the comments of one of my other videos a while back. If you have a request, let me know down in the comments. I'm going to go through today or tomorrow and get back with everybody that has commented over the past week or so. I've been out of town. And I'll get those tickers up on the chalkboard behind me. Eventually, I'll make a video for you. As always, this is not individual investing advice, just how I analyze stocks. I'll either post these videos here on YouTube or on the free tier over on Patreon, and that link will be down in the description. I also have weekly picks over on Patreon for $25 a month. And I have a full service over on Patreon now as well, where you get access to the spreadsheet you see me using here quite a bit. And you can contact me, direct message me, do all that kind of stuff. We have chat rooms for all those tiers as well. Okay, so my last video, I was out in the wilderness doing a little test to see if I could record from the middle of nowhere, and it worked pretty well. Back in the basement studio here today. So WSP Global, this is a Canadian company. I'm looking at the US ADR, which is WSPOF. I think on the Canadian exchange, it's WSP. Pretty simple. So I had never looked at this company before. They are a construction engineering company. So usually I avoid those companies just because what I've seen happen in the past is they can, if they have big projects, they can put in bids that are too low where they get a bunch of business, they get more backlog, which the market usually likes. But then if the costs come in higher than they bid, then they can lose money very quickly and perform very poorly. So my initial reaction is kind of to avoid those. But I'm going to take a look at this one anyway. I do think this one's interesting, and I probably would consider buying it under some conditions. So here's a little chat GPT description. So Canadian-based professional services firm specializing in engineering, environmental consulting, advisory, and design. So maybe a little bit more on the consulting end here than building a pipeline or something like that, it sounds like. So we have design, consulting, management. So maybe they might not have the same kind of issues that I normally would kind of make me shy away from anything in the construction engineering. So it's worth looking at what these companies actually do before completely writing them off sometimes. 73,000 employees. This is like a $30 billion company. So it's a big company. Global presence, 50 countries, so spread around the world. So I kind of like all that. It looks like they do a lot of kind of environmental work and transportation, it looks like. So yeah, kind of in all different sorts of areas. So it's pretty interesting, and one it's definitely worth looking into. I'm glad somebody asked me about it because I don't think I would have found it on my own. Looking at the US ADR, we have data going back to 2012. I bet I'll look at the Canadian listing too. So I'm using the ADR because it's easier for my spreadsheets for Google Sheets to find it. Yeah, so we go all the way back to 2007 if we want to look on the Canadian exchange here. So long period, it looks like a pretty slow growth. And then recently they've increased their earnings growth. Over the long term, we're looking at 16% earnings growth rate. I think over the shorter term, we're looking at a little under 15, which is what I'm going to use. So we're at, let's see, that's 2018. Let's go here, there. Okay. So about 15%. I think I used a slightly under that. I might have gone one more year back. But that's really good earnings growth. And the method I'm going to use here for valuation purposes is a time until payback method. So the idea here is you want to know how long it would take to earn your money back. If you bought the whole business, how long would it take for earnings to equal the amount that you paid for the whole business? So if you buy the business for $100, how long does it take to earn $100 back in earnings? So that's going to be a combination of the earnings yield and the earnings growth, the average earnings growth over time. So I'll look at the spreadsheet, actually see what, I think it was 14.86. So almost 15% earnings growth is what I'm going to use. So, and the earnings yield right now is 3.29%. So let's see what the PE. Yeah, that looks about right. So 33 PE, it's not cheap, but it has had pretty strong earnings growth. If you get 15% earnings growth, it's not like a steal. And usually at a 33 PE, I want 20% earnings growth as just a reference. As a quick reference. I would say they're a $27 billion company. You have to ask yourself, how big can they really get? So when you think about longer term earnings growth rates, I definitely think that 15%, assuming there isn't a bunch of inflation, which there definitely could be, is optimistic enough when we're talking like a decade or more of steady earnings growth. They've definitely had periods where they had earnings growth that was much slower than that. We can look at that on the fast graph probably. So let's just check it out for reference here. So if we go through a period like this, they only had 3% earnings growth. That's 1, 2, 3, 4, 5, 6, 7, 8 years, right? So you can have these periods potentially where there's definitely not 15% a year earnings growth. So I think that's a pretty optimistic estimate, but they've been pulling it off recently, and the market is thinking they can do it again. Let's see. Yeah, they're looking at 14 and 18. So that's right in line with the market thinks for the next couple of years. So I think that's a fair estimate to use. And then the earnings yield is just the PE ratio, which was 33, inverted. So earnings over price. And when you do that, let's see what. So I pulled forward this year's earnings for mine. So it's a little higher than the fast graph earnings yield of 3.03%. They use a blended PE. So again, I'm just making the point that I think I'm being plenty optimistic here. I don't think I'm being too hard on them when I assume they can grow. When I pull forward this year's earnings, and I assume they can grow almost 15% after that. So with that setup, I assume they're going to earn $6.85 on the US ADR, right? That number comes from right here. And so the way I like to think about this is, if I bought the whole company for $100, they would earn $3.29. Oh, sorry, excuse me. Yeah, that's right. $3.29 the first year. And then each year that $3.29 would grow at almost 15%, 14.86%. And I do pull forward the first year's growth. So I actually start a little higher than that. So that's what this spreadsheet is kind of set up to do. So I assume this first year you earn $3.78. You get to keep that money if it's like you own the business. The next year you earn $4.35. You get to keep that money, and then you add up this, you accumulate it, and you want to know how long it would take to accumulate the $100 that you paid in theory for the business. And you would take about 12 years. That's actually cheaper than the S&P 500 for sure. Now there is some question whether they actually hit this earnings growth rate, of course. But there's question whether the S&P 500 will be able to do it too, which is mostly just honestly like Magnificent 7 or Magnificent 8 or something that's driving the big earnings right now. So 12 years is fair. I mean, that's not bad. I like to see it below 10. So just below 10 when it switches to $9, 9 years to earn your money back. And that would happen at $131 a share for the ADR. So, and right now we're at 208 about for the price. So a little bit of a discount for it to fall, to hit the buy price. And that's with a little bit of margin of safety, because maybe, this earnings growth rate estimate turns out to be too high. So that gives you some wiggle room where you can buy it and kind of hold it for the longer term. What'd I say, 131? So it was trading at 131 a year and a half ago. So not that long ago. And much lower, all the way down to $100 a share almost back in 2022. So that's a price it could hit on a pullback, I think. You could kind of wait and watch, see if it hits it, and then maybe pick up a little. And I think this is a business you could probably hold for definitely the medium term, which is usually what I aim for, and see if they can keep growing the business. And if they can do that, then the stock price should follow. You can see that the stock price pretty closely, they've had multiple expansion, but it's because the earnings growth has increased. So the stock price reflects, you can see this big jump here happened when they had their big earnings jump. So as long as they can keep growing earnings, I expect if you buy the stock down around that 130-ish level, you're going to get pretty good returns. So yeah, thanks for asking about this one. I put the ticker on my spreadsheet to keep an eye on it. It's usually not exactly the type of stock that I buy, but there's definitely situations where I think, I might be willing to buy a little at the right price. Okay, if you found this useful, hit the like and subscribe button. Check out those links over to Patreon, especially the free tier, because if you ask for stuff, I usually try to tell people when I post them on Patreon, but especially like last week when I was traveling, I don't think I did. I think I just posted some over there that people had requested. Thanks for watching. See everybody later.